All right, let's jump right into this explainer. We're going to strip away all that social media hype and uncover the actual mechanics of trading. I mean, we've all seen those flashy posts promising easy money, right? But that illusion completely ignores the fundamental truths of how the market actually operates. So today, we're getting right down to the reality of the business.
$7 trillion. Every single day, over $7 trillion moves through the world's markets. Just to put that massive number into perspective, that daily volume is actually more than the gross domestic product of many countries combined. Stocks, forex, crypto, you've got millions of people and algorithms buying and selling continuously. Fortunes are literally made and lost in the blink of an eye.
But here's the fascinating part. You've probably clicked it yourself, maybe felt your heart rate spike a bit as the order went through. But what actually happens in the digital plumbing of the market when you click buy? Most people honestly can't explain what goes on behind the screen. So we're pulling back the curtain today. No get-rich-quick nonsense, just a clear, mechanical breakdown.
So here's our roadmap for today. We've got 1. Demystifying the trade. 2. Inside the order book. 3. Stocks, forex, and crypto. 4. The trader's toolkit. And finally, 5. Mastering risk management.
All right, let's kick things off with Section 1, Demystifying the Trade.
Let's just strip away all the jargon for a second. Trading is simply buying an asset to sell at a higher price or selling it first to buy it back later at a lower price. Think about the difference between holding and trading. Holding is like buying a house to live in for 20 years. You really only care about that long-term value. Trading, on the other hand, is like flipping a contract on that exact same house in 48 hours based entirely on market momentum. So unlike simply owning an asset, a trader is specifically betting on short-term price movement.
Moving right along to Section 2, Inside the Order Book. You can think of every market as this continuous, giant tug-of-war. Imagine a massive digital auction house where thousands of people are yelling out prices simultaneously. On one side, you have the bid. These are the buyers offering the absolute highest price they're willing to pay right now. And on the flip side, you have the ask. The sellers listing the lowest price they're willing to accept. Prices only move because of this live, aggressive clash of supply and demand.
So that literal gap between those two numbers, we call that the spread. When you actually hit buy, they're matching with a real seller right there in that gap. And that could be another retail trader like you, a massive financial institution, or, an algorithm executing trades in fractions of a microsecond. Their collective aggression is what dictates the direction. If buyers are eager, they bid higher, pushing the market up. If sellers are desperate, they drop their asking price, dragging the market down. Millions of these tiny digital handshakes are the hidden engine behind every single chart you see.
Okay, Section 3. Stocks, forex, and crypto.
Now, while the core matching engine we just talked about is exactly the same across the board, the arenas themselves are entirely different. Take stocks, for example. You're trading pieces of real companies during set hours, and it's largely driven by quarterly earnings and corporate news. Then you have forex. That's the largest financial market in the world, trading global currencies 24 hours a day, 5 days a week, and it's heavily driven by central bank interest rates and geopolitics. And finally, crypto. This is a 24/7, 365-day market. Because crypto doesn't really have traditional earnings reports, it's driven almost entirely by raw speculation, adoption demand, and market sentiment, which is exactly why it experiences such massive, high-speed volatility compared to traditional stocks.
Which brings us to Section 4, the trader's toolkit. First up is going long. This is the classic scenario we all know, driven by the pure optimism of a rising market. Going long is just buying an asset with the expectation that its price is going to go up. It's as straightforward as buying Bitcoin at $60,000, riding that upward momentum, and hoping to sell it to someone else at $65,000.
Now on the flip side, going short allows you to bet that a price is going to fall. And honestly, this one often trips people up. So let's make it concrete. Imagine you borrow your friend's brand new video game and instantly sell it to a stranger for $50. A week later, that same game goes on sale at GameStop for $20. You buy it back for $20, return the actual physical game to your friend, and boom, you pocket that $30 difference. That is exactly how short selling works in the financial markets. Borrowing an asset, selling it high today, and then buying it back low tomorrow.
Next up is leverage, which basically lets you control a massive position with just a small amount of your own money. But listen, this is the ultimate double-edged sword. While 10x leverage can beautifully multiply your profits by making $1,000 control a $10,000 position, it multiplies your losses with the exact same ruthless math. A tiny dip in price can wipe out your initial capital instantly. This is exactly how beginners blow up entire accounts in a matter of hours.
Then we have liquidity. Now, why does this matter to you? Well, imagine trying to sell a rare collectible coin versus a crisp $10 bill. The bill is instantly liquid, everyone's going to take it. The coin? That might take months to find a willing buyer. In trading, liquidity refers to how easily an asset can be bought or sold without dramatically moving its price. Highly liquid markets, like major currency pairs, have really tight spreads. Low liquidity means you could get trapped in a plummeting position simply because there's literally no one on the other side willing to buy it from you.
And finally, volatility, the roller coaster. This is the absolute heartbeat of the market. Volatility simply measures how much and how fast an asset's price moves. High volatility equals much bigger potential rewards for sure, but it also brings significantly larger risks to your portfolio. It provides that daily opportunity to profit, but it's also exactly what shakes out amateur traders who panic and sell the second a chart violently spikes.
So how do traders actually predict if an asset is going to go long or short? Well, they generally rely on two different analytical lenses. Technical analysis involves studying price charts, historical patterns, and collective market psychology. It's really about reading the momentum, and it's usually favored for short-term trades. Fundamental analysis, on the other hand, looks at the underlying true value, stuff like company earnings, economic data, and broad market health, which is favored for longer-term outlooks. Actually, neither lens is inherently correct. They're simply different tools for different timeframes, and the most successful traders out there often blend both into one cohesive strategy.
And that leads us to our final and arguably most important section, mastering risk management.
This right here is the absolute safety net that separates the pros from the gamblers. Step 1. Size your position. Never ever put your whole account on one trade. Professionals risk only 1 to 2% of their capital at a time. Step 2. Set a stop loss. This is an automatic instruction that cuts your losses and closes your trade the literal second the price moves against you. Step 3. Calculate your risk to reward ratio. You should target risking $1 to make $2 or $3. Why is this rigid system so necessary? Because even the best traders in the world are frequently wrong. It's not about being right all the time. It's about making sure that being wrong doesn't cost you everything.
And that brings us to a pretty harsh reality check. Social media loves to show you these screenshots of massive overnight wins, but the truth is that around 90% of day traders lose money. Why? Mostly because they treat the market like a casino rather than a game of chess. The market rewards rigorous patience, emotional discipline, and continuous learning, while rapidly and ruthlessly punishing impulsiveness and greed. It is a highly developed skill, not a lottery ticket.
So I want to leave you with this final question as you look at the markets today. Will your next trade be a gamble or an education? If you want to survive and actually thrive in these markets, you've got to start small. Treat your early trades as tuition for your financial education and focus heavily on understanding exactly why a trade worked or failed rather than just if it made money. Keep learning, stay focused, and I'll catch you on our next explainer.